Let me now bring on board Jim O'Neill, represents Goldman Sachs, the man who famously coined the acronym BRIC. Jim, good afternoon to you. Thank you for joining us. Jim, I'm sure you've read through the union budget this year. What is your first reaction? And as a portfolio investor, are you satisfied with the budget maths?
To be honest with you, I've had major problems getting through London traffic today, so I haven't read it closely. What is it? The markets don't seem to be very impressed initially, so there's obviously something that's been a bit of a negative surprise. But it seems to me there are underlying issues that make the budget background difficult, and I guess they weren't gearing us up for some major positive initiatives. But it looks from the market's reaction as though they're not happy about the macro framework the government is presiding over still. So it's a bit of the market's reaction is a bit disappointing.
Right, Jim. So, to your mind, do you think budget, no budget, will India be a performing or outperforming emerging market for this year? Because for last year, which is 2012, India emerged at the top of the heap. Do you think India will once again emerge as the top performing market this year as well?
I think China's going to be the place to be out of the BRIC countries this year, because I think China is showing two really powerful signs. One is that it's picking up recovery after this big slowdown last year, partly government policy engineered. And secondly, it's showing lots of signs of rebalancing as it goes through this new phase of growth to being less dependent on its old model, including less dependent on exports. And that's a really good thing, and I think that's why the Chinese market has since November and is likely to continue to be the better of the major emerging markets. As it relates to India, I think that there are underlying issues that the government has flirted with trying to deal with, but it's not really coming to grips with that. And I often find myself thinking that maybe Beijing and Delhi should swap places in terms of some aspects of their policy style, because Delhi and India needs a much stronger and more, at the same time, ironically, more simple framework for macroeconomic policy. So to have some clear path for deficit reduction in the future, and to really focus on a low and stable inflation rate as some kind of monetary policy anchoring has become so powerful and important in other large parts of the emerging world. And the macro policy framework is as always quite confusing for many people. And then on top of that, of course, markets, and this is partly what drove the strength last year, markets are always looking for Delhi to grant more openness and more attractiveness for foreign investments. And there has been some progress made in that direction, but against the background of continued creeping Indian current account deficits, it's important because India needs more foreign capital and not just portfolio capital.
The India story always has been great demographics and strong consumers. But given the way how Indian inflation has moved in the last 3 years, are you getting a sense that Indian consumer is slowing down, and that in a sense is negative for Indian equities?
Well, as I just said earlier, I think the macro policy framework has not been helpful for sustaining Indian growth. And I think the pickup in inflation is, of course, an issue that has slowed a number of parts of the economy, including the consumer. And the big picture Indian story is based on the strength of the demography and the urbanization of Indians' huge population. So this is one of the reasons why I have talked about for years the importance of putting low and stable inflation at the anchor of Indian economic policy. And I continue to be frankly mystified as to why Indian policymakers do not adopt some kind of inflation target as a core to their macroeconomic policy. I think given how important these issues are for Indian consumers, particularly the lower income ones. I think the only surprise to me is why they don't do it.
What I'm trying to understand from you, Jim, is the following. Second half of this year, do you think risk-on trade will dominate global markets or risk-off trade will make a comeback?
I continue to be amongst the more positive people, and I think therefore, just sort of, if we could answer it so simply, I'd be risk-on. But one of the things that adds to my underlying optimism is that some of this sort of rather simple brush risk-on, risk-off that has dominated since post-2008 is actually appears to have come to an end. You've got a lot of things going on around the world, some of which are clearly positive, some of which are clearly negative, and markets are trading off different fundamentals, which for investment managers should be really good, because it means not everything's being driven by the same thing. You've seen an example of that this week, where you had this very surprising Italian news in Europe, which led to a really bad performance of European markets, which dragged the world down. It made people think, oh, here we go, risk off. But yesterday, because of better news on the US budget discussions, and in particular, very good data on US housing, and then this morning in Tokyo, confirmation of the more aggressive incoming Bank of Japan policymakers, you see those markets doing very well, which means people who are Japan-focused will not be getting too negatively influenced by what's going on in Europe, and that's a sign of a much more vibrant underlying investment market.
We've had this transformation of the Indian stock market. It started off very strong and gone all the way down, apparently because of an issue about Mauritius, whether certain tax issues will be opened up. If the finance ministry just comes out with an easy clarification on that, do you think we will get a quick reversal? Or do you think there are more serious questions on whether or not the Indian tax people are getting their knife into the foreign investor to somehow extract money one way or the other?
You know, I think if there was some clarity given about the Mauritius tax issue, that might cause a rally. But I was quite intrigued by what one of your other guests has said about her 20-year experience of following markets pre- and post-budget. And it is striking today that this disappointment in India comes against the background of a very strong market around the rest of India. Tokyo's up nearly 3%, Shanghai 2%, etc., etc. And in terms of global capital, markets frequently travel on policy expectations as well as cyclical momentum, and the thing that, and remember I said early on I haven't had a chance to see that much, but listening to all of you guys, it sounds as though this budget is unique in that it's not really got any great initiative, and that means that unless the Indian economy starts to quickly positively surprise cyclically, it's not obvious to me why in the near future the Indian market is going to feature relative to some of the very exciting things going on in other parts of the rest of the world, both developed and developing. That being said, one never writes the Indian market off. Last year was a disappointing year for the economy, yet, as we discussed earlier, the Indian market the strongest of the big markets. So I think the underlying earnings outlook and strength of India's dynamics mean that one shouldn't get too negative.